Sir, let's talk about the financial services sector now. In terms of financial products, we have seen number of demat accounts going a record through the roof in our country. We saw SIPs going almost record high every month. It appears that people are, for a variety of factors, are really moving towards financial assets. What are the trends you are observing there?
See, yes, indeed there is a move towards financial assets. There is no question about it. As I said, it moved from land and gold to banks, and now it's going into hard financial assets. The reason that is driving it is to be understood, and it's very clear to me. Again, there are 2 or 3 underlying things which are pushing this. The first is, I think the saver is looking for higher yield. The banks were not providing that yield, so he's moving away. And the banks are in a catch-22 situation. They have a challenge. Whereas other products are providing higher yield, whether it is debt instruments or equity instruments. The reason why we see the number increase, and I think it will continue to increase, is the ease of dealing with these products today. Compared to 5 years back, when you had to physically deal with an instrument, today you are digitally dealing with the instrument. And the entry of new players into this space who are completely digital, as opposed to banks which are still physical and digital. Largely they are also moving, but here it is visible. It is basically a digital move. I think is what you're seeing in terms of growth in opening of accounts, and B, the SIP growth as we see. And I think it will continue. It will only accelerate.
So we have, say, around 11.5 crore demat accounts and say around 4 crore individual folio numbers. In the next 5-7 years, you see huge growth there.
I would look at this sector growing at 20%. So in 5 years, you say it will be 1.5 times, 2.5 times where it is. So it will double in 4 years. It will double.
Okay.
And the 5th year, it should then give another 25% growth.
But the way overall Indian banking system is underwriting risk right now, conducting the exercise of lending, and the frailty of banking system, which was say 1.5 decade back, that doesn't exist anymore.
I can endorse it. It doesn't exist. You see, and I'll give you a thing to it. The structure of lending 10-15 years back was on a particular basis. If I go back 20 years back, was on the basis of an India where there was nothing and we had to build. So we said debt equity ratio will be 1:2, 2:1, 2 debt and 1 equity. And every project would have that, because that's how India grew from 1950 to almost 2000. Then it became in terms of, it's not a sacrosanct ratio. It can be a higher ratio or a tighter ratio depending on cash flow. So it changed. And I think there have been a lot of learnings in the last 10 years. What is the primary learning? If I look at post-opening and post 15 years last year, that there are risks which are, not measurable a priori. So you need to make sure those risks are what we call implementation risks. It could be land acquisition, it could be mining rights, it could be spectrum rights, it could be a variety of these things. Access through an area which is environmentally fragile. All these we did not know in the past. And when suddenly these were brought to the fore, as the project was being implemented, a lot of projects got hurt. I am looking at real reason why a number of projects have failed. Now, all those learnings are with us, and I cannot see any banker now making that mistake again.
Once again,
they are documenting each and every risk very clearly and making sure that those are addressed before you go ahead. So I'm not worried about the Indian system at all.
So one